On the podcast with us today is Dustin Miles. Dustin, welcome to the podcast.
Awesome. So excited to be here. Yeah, thank you so much.
I'm looking forward to diving into this Aspen walk, which is 147 units that your group recently exited in December of 2018. But before we dive into that, I want you to give us a little bit more of a kind of insight into your background and where your relationship is right now in this multifamily space.
Yeah, thank you. Appreciate it. So just a little bit of background on me. I went to went to school for engineering, went to UT Austin, hook 'em horns. And I've always been pretty entrepreneurial. When I was a little kid, I had a candy business, lawn mowing business, sold baseball cards, had all businesses. The bus driver, whenever I was selling candy, called me the candy man. I was 8 years old. But and then college, I had an internet business. And then, so always very entrepreneurial and started flipping houses and did rentals. And then found some people that were doing multifamily. And so always kind of had the eye on going bigger and honestly, I didn't understand and didn't know that normal people could get involved. I'm just a normal person, came up from, middle class family. I went to engineering school. So anyway, started syndicating deals. I was passive in my first deal in 2012 and then started syndicated my first deal in 2014. And then, haven't looked back since. I've sponsored, co-sponsored, or whatever the term you want to use, depends on the group, but I've been a part of 9 deals where I'm, helping to put the deal together. I've asset managed, done kind of the whole array of things. So, yep.
Well, that's pretty cool. That's pretty exciting. So on this 147 units that's located in Oklahoma City, let's first kind of talk a little bit about how you found that deal. Because I know we talked about it a little bit in the green room. It's been 3.5 years since you acquired that asset and you exited it recently. Right. So you had to pull away some cobwebs a little bit there. But talk to us a little bit about how you found this deal originally.
Yeah, thanks, Dan. So we found this deal as off market, or it was, I'm sure, being floated to a few different people. Most of these deals are not purely off market. There's usually a handful, but I found it through a broker. It was a broker relationship, and I'd been fostering that relationship for probably 9 to 12 months before she showed us this deal. And we're like, hey, this looks interesting. So it was, we actually had under contract this deal along with another deal. We ended up dropping the other deal once we got into due diligence. The other deal had a lot more roof issues than we anticipated, so we ended up having to drop the contract. But yeah, this deal was off market. It was a California seller. He owned it, for a while. He self-managed from California. It was, did things through fax. So that, presented its own challenges and the financials were right. Exactly. Yeah. Yeah. So he would send stuff through a fax machine. There is, the part of the attraction in general for Oklahoma and some of these, other maybe a little smaller markets is there's a lot of mom and pop. And so where there's mom and pop, there's usually a lot of opportunity. And that was certainly the case with this deal. In terms of getting the deal under contract, it was very slow. Typically we'll have a deal under contract in, a week to 2 weeks is kind of the typical. This one took 4 to 6 weeks. It was very long, drawn out. We would send back our, changes, and then a week and a half would go by, and then they would reply, and it was just very, very slow, very difficult to get any paperwork out of them. Finances were, we had to kind of reconstruct. So the finances were not on notebook paper, but not too far from that.
So on this particular asset, 147 units in Oklahoma City, Aspen Walk, what was the purchase price on this one?
Purchase price was 4.9 million. We bought it in June of 2015.
Okay, June of 2015. And how much did you put in for CapEx?
Our CapEx was roughly 350.
Was that mostly interiors?
It was. We didn't. Oklahoma City is not a place where you can really, you can do some interior and see a little bit of a bump, but for the most part, like in Dallas, I'm in Fort Worth. I'm a DFW guy, so in DFW, we can spend a little bit of money. We used to be able to just do two-tone paint, throw in some vinyl flooring, and charge $100 more. You can't do that in Oklahoma City. So we did clean up the interiors, but we didn't spend a whole lot of money just because the ROI just isn't there. There's quite a bit for maintenance, so that's where a lot of the dollars went.
Okay. And what kind of deferred maintenance was there on this one?
On this one, the parking lot was a mess. Frankly, the tenant base was, there are some folks that probably shouldn't have been there, which is typical. Mm-hmm. So tenant base was kind of a mess. The sidewalks, the lender really hammered us on that, and so we had to do a lot of sidewalk repair. We did water conservation from the get-go. We knew there was a big opportunity there. And I don't remember the exact number for water savings, but it was over 50% savings. It was, probably closer to 60. So pretty impressive. I don't remember exactly our water bills, but they were around 6,000, 7,000, and we went down. We were sub 3,000 per month.
Wow, that's great.
Yeah, I know, it was pretty sweet. So, and then other, just balcony stuff, just paint. The pool hadn't been operational in a long time. The office was straight out of 1974. It was so we completely redid that, and it looked fantastic when we were done. So, and then in throughout that process, we actually had to change management companies too, which is another. I don't know if you've had to change management companies before, but it's not very fun.
Yeah, well, we're hoping we don't ever have to do that, but I can imagine it's just like in my space in the medical field, when we change from like one EHR platform to another one, it's like a nightmare. But usually at the end, though, you're glad you did it.
Yeah, no, yeah, absolutely. Yeah, it was just, it's one of those deals where just, occupancy and income weren't there, and on the CapEx side, things weren't getting done. And so it was time to part ways. But they did remodel the office, and they did a fantastic job there. It was, complete 180 from what it was before. So, yeah.
Let's talk about this water conservation and talk to us a little bit about what you did there to be able to achieve those kind of savings.
Yeah, so the company that we had parted ways with, they introduced us to a company, American Water. Happy to share, and so we actually got quotes from them and a few other people. Want to keep make sure that someone's not incorrect or anything like that, or is incorrect. But we got a few bids, and everybody was kind of in the same ballpark, and the total cost I think we spent was around $45,000. And so, I don't have a calculator in front of me, but, if we're spending, if we're saving $3,000 a month and we spent $45,000, our payback was a little over a year, which is pretty awesome. And then the cap rate for that area in general, we bought and sold at an 8 cap. So with this deal, we didn't have, on all the Texas deals, I'm having massive cap rate compression, and cap rate compression just means that we bought it an 8 or a 9 cap, and now we're selling it at a 6 cap. And so, for instance, I just know this number, from an 8 cap to a 6 cap at $500K NOI, literally you could have bought something at an 8 cap and then sat on it, sold it at a 6 cap, and you made $2 million just on cap rate compression. So we didn't have any of that here, and did well for our investors.
So inside of that project that American Water did, what were some of the things that they were changing out? Was it like low flow toilets and low flow shower heads, things like that?
Yes, yeah, exactly. And then they put the aerators on and all that. So it was a complete change out. I think they used, man, it's been a while. I think they used Niagara, and I don't remember if they used I don't remember if it's point. I don't remember. I can't remember if it's below 0.1 or if it's 1.2. But nevertheless, we saved a lot of money, and it was awesome.
So with the water on this particular asset, were they already billing it back to the tenants, and so you just continued that, or was it just completely okay? Wow. So did you? Start to bill it back to the tenants?
We did, yeah. So that was another source of, so there were a few, real big, pretty decent sized sources of income or profit centers. And, the water conservation was a big one. And then billing back water was another one. We didn't bill back. So we weren't super aggressive on it. I think we ended up getting about 24,000 to 30,000 a year. In extra income, but 24,000 a year, divided by an ACAP's $300,000. So not spending any money at all, just doing a paper change, just changing the lease, we made $300,000.
No, that's phenomenal. I think you guys did a great job there with both the water conservation and with the billing back of the water there. So going back to, you found the deal, broker gave it to you after you built the relationships with them for, 9 to 12 months, got this deal, semi off market, probably shot with a couple other groups. What kind of offers, or before we go to offers, how many, at what point did you tour this property?
I toured it pretty early on, before offering. Oklahoma City is about a 3-hour drive from where I live in Fort Worth, so it's not a bad drive at all. It's fairly easy, as long as you go at certain times, not a whole lot of traffic. But we toured a handful of properties, before offering, or really, I think we toured this one before we got the financials on this one. Which is not how I do things now, but I was really working on building relationships and all that. So I had to do a lot more legwork to begin with, because she wasn't going to show me this deal unless I basically came up there. So it was kind of a, hey, come up here and I'll show you what I've got. She wasn't just going to send stuff out. So.
Well, and I think it's important for people who are listening right now to understand that, when you're first getting started and you're kind of got these first couple of deals that you might have been doing or whatever, and you're trying to make that reputation with that broker, you got to show up. You have to be able to show. I'm sure now you have a relationship with this person that if they had a deal, you wouldn't have to go and look at it right away because you have already built that relationship.
Right. Yep. Exactly. Yeah. And it's huge. Yeah. Just, they're like, well, if you're serious about it, you'll come out here. And if you're not, then, go to the next person. So
how many rounds of offers did you go through on this one?
It was just, I guess just 2. We submitted an offer, and then they came back with the price, and then we ended up, at 4.9 at the end of the day. So it wasn't too bad as far as back and forth.
And what kind of earnest money did you guys have to put up on this one?
So this is coming back to me now. So the earnest money, they originally, there were more than just a back and forth. Okay. Cause it was down to earnest money.
Cobwebs are now moved out of the way.
It is. Yeah. Yeah. Thank you, Dan. So we were good on price. It was earnest money. So we offered, I forgot what it was. I think we offered 50,000 or something in earnest money, or I don't remember exactly what it was. Or it was 49K. And so they came back and they wanted us to put down 300K, or it was 250 or 300. I can't remember. And I was like, nope, we're not, I'm not doing that. And, it was funny because, anyways, we kept on going back and forth. And so it was 300, then it was 200, then it was 100. And then it's funny because we ended up, so I offered originally 49K and we ended at 30K. And I don't remember how that occurred, but, that was my, kind of my last offer. I was like, well, I'll do 30. And, so it actually ended up below what I originally offered, which was kind of funny. But yeah, they want a lot of earnest money. I guess, it kind of goes back to your talking about, potentially goes back to that relationship and, hey, are these guys kicking tires? Are they just trying to get it under contract? And then, oh crap, what do we do? Or, they just wanted to make sure we were serious and we were going to close at the end of the day. So.
Yeah. Did that Earnest Money go hard after due diligence, or was it before due diligence, like day one?
It was after due diligence. We had at least, I think we had a financing contingency, in there and all that. So this was 3.5 years ago, and it's in Oklahoma. So it was kind of a different climate then. There wasn't in DFW at that time. I don't think there was a whole lot of hard money. I'm trying to recall. I don't think there was a ton of hard money day one at that time in DFW. So it's just different climate.
Yeah. What about right now? Is there any going on right now in Oklahoma City?
As far as hard money day one and all that, there's so I actually have a property on the market right now up there to sell. There's I think there's some. It just depends on, sometimes you'll have guys that offer a higher price and then their terms are a little bit better on their side, or you're the other way around. So I think you'll see a little bit of, if people really want the deal, you'll see some hard money, but it's not as prevalent up there as it is down here. So, yeah. Or in, other markets that are hotter, like Atlanta or the Carolinas, I'm sure. So,
yeah. So how did you end up financing this deal?
This was, so we shopped it around. We ended up going with Berkeley Point. I had a relationship with them. I had assumed a loan from them about a year before that. And so I had a relationship, and so yeah, we ended up getting financed through them. It was just a Fannie Mae loan.
So it was Fannie Mae, non-recourse, typical debt.
Yep.
And what kind of debt was it? Was it just a 10-year fixed, or?
It was a 12-year fixed. We got a little better terms at that point. And some hiccups we had with this deal was we had, so at the time, and I'm not an economist, but at the time, Greece was having lots of issues financially. And so interest rates were fluctuating, by quite a bit. And so I had to hurry up and lock it in. I think our rate was 5.05. And, when we got into the deal originally, because this thing just moved very slowly, when we got into the deal originally, we were, rates were like 4.5 or so. They went up to 5. I think they ended up spiking around 5.5 or so. So we locked it in, as it was kind of on its way up. But and I don't believe there was any IO on this deal. Just a 12-year fixed deal.
Okay. The 12-year fixed.
We were, as far as leverage, I think we were around 75% with rehab and everything.
Okay. So they also financed the rehab?
That's right. Yes.
Okay. All right. And so no interest, 5.05. This is 3.5 years ago, 4 years ago now. 12 years fixed. On this particular one, I'm trying to figure out, Oh, was it assumable?
It is, yeah, it is assumable. And when we sold, that's the way. Just because the yield maintenance was so high, that's how we sold it. We sold it as an assumption. We were going through either an assumption or adding a supplemental on it, but this group chose to go ahead and just assume it, and then basically they were going to build up the income and then, maximize their supplemental proceeds that they'd get a little later down the line.
Yeah. Yeah. That's what I was thinking on that one. Yeah, we closed one in December last year, and I think that interest was right at about 5, on that one, maybe a little bit less than that, 4.9 or something like that. And then we just had one close. I think you were talking about it in the green room, just one last week, and we got it for 4.01 is what we locked it in at.
Oh my gosh.
Yeah.
Wow.
And
awesome.
it was 5 years IO, 10 years, 10 year,
Oh, wow.
10 year Freddie, a 10-year Freddie with 5 years IO with 4.01.
Wow. That's awesome. That's a great
It's got
rate.
yield maintenance on it, but chances are the interest is going to be a little bit higher in the future. So the yield maintenance shouldn't be high.
Wow. That's awesome.
Yep. All right. So that's kind of neat how you structure that one. Let's talk about any issues that came up during due diligence. I know you mentioned like the sidewalks that gave you a really hard time on and made you do some repairs on. Anything else that came up during that due diligence process?
And Frank, the sidewalks needed some work, but the lender was the one that really pushed on the sidewalks and went, I thought, overboard. We spent a lot of money on sidewalks, but for the most part, it was, we knew what we were getting into, otherwise, but, it was, the due diligence was fine on that one. On the other one that we also had a contract on, like I said, the roof was a no-go, and so we just had to cancel the contract there.
Did you find anything during your unit walks or during your lease audits that kind of made you, think a little bit differently, or those go pretty well?
They went pretty well. It was, like I said, we knew what we were getting into as far as the tenant base and all that. We knew there was going to be some decent turnover there, and there was. We had, it wasn't extremely low occupancy, but we were down in the lower 80s for a little bit before, building back up into the 90s. It was, we kind of knew what we were getting into for the most part. I remember due diligence, I think it had just snowed up there or iced or something. And so, due diligence was just kind of interesting from the standpoint of just, holding on to the rails as you're walking up steps and all that, because a lot of the steps were icy. And so it was fun. It's interesting. So
how did you structure this deal with investors?
We did an 80-20 split with investors. It was a 506B, and there was an asset management fee of 1.5%. It was pretty clear cut deal. And the way we do our deals, and I think most other people do this, is we when we're selling a deal, basically all investors get their funds back minus distributions to make them whole, and then the split is 80-20, and then cash flow is split 80-20. So, it ended up, frankly, we had distributions were slow to get going on this one. Like I said, we changed management companies, and that that kind of put us behind the ball a little bit. Anytime you have, change in the office and all that disrupts things and put us behind a little bit. But overall, real happy with the way everything turned out.
So I want to peel back the curtain a little bit about, during that process, during that time where you're like having to maybe delay distributions just a little bit longer than you might have planned or expected. Did you have a lot of pressure from your investors kind of, reaching out and asking you questions? Because I can imagine that can be pretty stressful.
Yeah, absolutely. I did. A lot of people that a lot of the investors I'd known for a little while, and so I was like, hey guys, it's taking a little bit longer than we anticipated, but we'll get the train going and we'll be good. And then I had a few people that were got pretty vocal, and that's just that's part of the game. So I did get plenty of pressure to distribute, and I'm like, I'm not going to distribute until it makes sense to do so. I'm always going to do 100% of what's best for the collective whole, and you just gotta stand your ground.
As I say, I can imagine that could be quite stressful and lots of pressure coming on, especially, from investors, from, wanting to get their distributions and stuff. I'm sure at the end of the day, they were happy when you exited it and were able to, make some nice, increases in the value based on a lot of the things you've already mentioned.
Yeah, absolutely. So one thing I'll mention is, I'm from Texas. A lot of the investors that we have are from Texas. And so they're used to, doubling doing really, really well within a short amount of time. And a lot of that is frankly because of, a lot of the deals, it's because of cap rate compression. And and a lot of these people are getting, heavy cash on cash returns because in DFW rental rates have gone up through the roof, averaging 6% per year and all that. And so a lot of these people are getting, 10, 12, 15% cash on cash, and we're getting nothing for a while over this Oklahoma property. And so the problem was, putting things in perspective and not to make excuses, but they are very different markets, and you're not going to have rental rate increases in Oklahoma, comparable to Texas. That's just how it is. So, and this is our first deal up in Oklahoma. We didn't, we did a lot of homework, but there's always things that kind of pop up. And, at the end of the day, real happy with the way it went, but there was, setting expectations with investors, or resetting expectations. So that was interesting. But
what kind of ongoing communication do you have with your investors once you get into a deal with them?
Yeah. So I do monthly reports. There's some people that, want a little bit more than that. I'm happy to talk with them and all that if it's, but at the same time, I want people to respect my time as well. But yeah, we have monthly reports, and then, sometimes some of the investors will want me, once a year, or, just kind of see how things are going. So, but normally it's, monthly, and then, sometimes we'll have a quarterly meeting or something like that just to discuss things. But, so it's communication's ongoing.
How much did you end up having to raise on this one to close it?
It was 1.512.
1.512. Okay.
I'm good at remembering numbers, but yeah, names.
How long did it take you to raise that?
It was pretty quick. The only difficulty, so we, in the pro forma, or, whenever we're sending out to investors, we had a very low cash on cash for year one, and we knew that was going to be the case. And so that was really the major pushback we had from investors, was they wanted cash flow out of the gate. But we were able to raise the money fairly quickly.
Okay. For those investors that don't mind holding on for the long haul, the long term.
Right. Yep.
Okay. And let's see here. All right. So I want to ask you a little bit more about how you got to the point in making the decision that, all right, it's time to sell the asset. Can you walk us through that thought process?
Yeah. So we did the water conservation, which we talked about, and for build back of water, we had a year plus to where, our other income had kind of leveled off. We had gotten everybody, on the new lease that said they were going to build back for water. And the one thing there's actually two things I haven't mentioned there as far as value adds for this deal. One of them is pretty substantial, about as much as the water bill. So they were offering not just basic cable for free. They were offering extended cable for free, and none of the other complexes were doing that. And we had done the market research, and we saw that. And so for extended cable, the retail was $60 to $70 per month retail. And so they were getting this for free. We knew because I reviewed the contract, I knew when the contract was going to be up. It was going to be in about year 2.5 to 3 in our deal. And so I had canceled that contract. The value on that contract was about $42,000 a year. So if you divide 42,000 divided by an 8 cap, that's over $500,000. So literally we spent no money. We waited for a contract in, and we made $500,000, basically a 30% return on investors' money by a contract going away.
So, because walk me through that a little bit, because I know there's different types of contracts that you can get with these companies. Sometimes you can get a contract where you actually get a kickback for only having one option on the property, but this was only one option, but the actual landlord was the one who was actually paying for the service.
Yes, that's correct. Yeah, it was a
terrible contract.
I know. I don't know why this guy signed this. But anyways, I guess he was having occupancy issues, or I don't know what he was doing. But yeah, he signed this contract, and so he was obligated to spend $42,000 a year, or I'm sure it escalates as you go, but for 10 years. And I knew that contract was about to end, and I was going to cancel it. And yes, we did get a little bit of pushback from residents, but at the end of the day, we're like, look, no one else is offering this, and they're going to be charging us a lot more, and we can't afford it. So we're going to cancel it, and we did that, and create $500,000 in value.
So the tenants now just go in and just get their own cable or whatever they want.
Yep, exactly.
Did you consider trying to get some kickbacks from that too, to have like just one option, or?
Yeah, so I did end up signing a contract with AT&T, and yeah, they were giving us a small kickback, and then we got a signing bonus based on the number of doors as well.
Yeah, that's cool. At least the signing bonus is not good for the person who's buying it, but it's good for you as the person who owns it.
Yeah.
That's always nice. But the kickback was ongoing.
Yes, it's ongoing. And then, like I said, there was the initial, the bonus as well. And then if you want to, I can talk about, there was another value add that we did. We spent a little, we spent a little bit of money on this. So they had a unit above the office. It was humongous. It was 1,700 square feet. And this was the manager's office or the manager's apartment. So whenever we bought the complex, that's where she had formerly lived. So we turned that into 2 units, just it's stairwell, and spent about $20,000. And I don't remember. Let's see. One of them was more of an efficiency. I think we charged $500-600. I don't remember. And then the 3-bedroom we were charging, I think, $900. And because of the way, because it was all kind of attached to the office and all that, we had to do all bills paid. Just because it was just more difficult to do the electricity otherwise. But so anyways, we ended up creating, so if you take those two numbers, multiply it times 12, and then divide by an 8 cap, is over $200,000 of value that we created by spending $20,000. So we had a few of these profit centers really add up for us.
No, that's great. That's great. So at what point after implementing all these, major pieces, did you decide, hey, let's see if we can sell this thing?
Our contract was up in December of 2017. And that's about when I really started talking to different brokers. I believe we ended up rolling out the deal that spring, April, May, may have been June, but kind of in that first, probably Q2 is when we rolled it out. And so yeah, but kind of for me, when, because you're asking about, well, how did you decide to sell? And for me, I'm like, okay, we've kind of squeezed, we've kind of grabbed a lot of the lower hanging fruit. Our occupancy was good. I think we could have pushed rents a little bit, but it's a lower income area, so they're a lot more price challenged than some other areas. So if you start bumping up rents, too much, then your delinquency and other things and occupancy starts suffering a little bit. But so at that point, it was, okay, we had the low hanging fruit, and the cable contract, which is a big one, was out of the way. There wasn't a whole lot of other knobs or big profit centers left in my mind. And so for me, it was, hey, let's go ahead and sell. The market was, fairly hot. We don't, I can't predict the future. I don't know what things are going to look like. And in my mind, I know everyone's different, but in my mind, if the money's on the table, I'd rather go ahead and take it, protect, investors, their investment, make sure that they're doing well. I'd much rather do that as opposed to, hey, let's hold on to this and maybe we can do a few things. I'd rather just go ahead and, get, churn their investment, get the dollars back to them so they can go place it in other investments.
Mm-hmm. Yeah, that's great. That's great. And how long? So you launched it in April, May, or whatever. Did you use the same broker
Yes.
that you bought it from?
No, I got a few different BOVs, and we ended up going with it was actually a Dallas broker that we had a really good relationship with, and they have a pretty large team. So we ended up going with those guys, and yeah, real happy with the way everything turned out. So.
Mm-hmm. Mm-hmm. That's awesome. That's awesome. Well, let's kind of tie it all together here towards the end, and first let's talk about is there anything about the deal, this entire process that maybe you're thinking in the back of your head we should talk about that we haven't talked about yet, or have we kind of like hit most of the stuff?
I think we've hit most of the stuff. I think I mentioned earlier, we've had a lot of, especially the Texas deals, have a lot of cap rate compression. We, up there, we bought it in 8 cap, sold it in 8 cap. We ended up increasing the NOI by about 25-30%. So was pretty happy about that. Yeah, so I think we've kind of hit a lot of the larger points. A lot of the other properties around there had traded during our ownership and all that. So it was it was nice to see the area kind of felt like I don't know, I'm sure some other people were in there, but we bought in, and then some other people bought in, and hoping to just create a better community for everybody there. One thing that we do, or that I like to do at properties, because frankly, I think it's the right thing to do. And then just from, if you're just looking at it from an ROI perspective, I think it makes a whole lot of sense. So I try to do, pool parties, pizza parties. We try to do a lot of fun, hamburgers, hot dogs. We try to do a lot of stuff for the residents, because, I don't remember the exact expenses on this deal, but it's probably 30 to 40,000, per month. And for us to spend, a few $100s is really a drop in the bucket. So I think the ROI is huge. It's, it's a good thing to do. It's a feel good thing. And I think it's just the right thing to do. So that's something that I really push pretty hard. We try to do Easter egg hunts, try any holiday. We try to do some fun stuff for kids. So
yeah, I think that's very important for getting referrals for the property, but also for getting people to kind of stay as a community, wanting to stay longer too.
Absolutely. Yep. Yeah. It's a win-win all around. So
I have two final questions for you. The first one I always like to start with is what did you find that was easier during the entire process that you might have thought originally was going to be a little bit harder?
I would say that, good question. I guess I would say that through the process, the money raised was probably a little bit easier than I was anticipating. Frankly, I was, if I kind of move the cobwebs away and recall back to 4 years ago, I was pretty nervous about it. Was the first deal in Oklahoma, and there's lots of question marks. Who's this management company you're going with? We've never heard of them. But I felt like we had a really solid business plan. Did a heck of a lot of research, and so I thought everything was pretty tight from that perspective. But I was still nervous about raising, money. A lot of the deals are really expensive now, so 1.5 isn't a whole lot. But a few years ago, that was, it was a mid-range raise probably. So I was nervous about it, and but that ended up going easier. That ended up going a lot better than I thought.
Yeah. And then the final question is kind of the opposite of that is what did you find that was harder than expected during that process that you thought might have been a little bit easier?
So this was the second deal I syndicated or sponsored. Really, and this is just kind of I'll make sure I answer your question, but the biggest thing, I'm not gonna skate it, but the biggest thing is that it's crazy how much the person in the office can affect the property. I mean, we're hiring someone $40,000-$50,000 a year. They're in charge of this $5, $10, $15, $20 million asset, and it's crazy how much things can affect all that. So I think in general, because I'd kind of been spoiled, being in Texas, had kind of knew who to go to for management and all that. And so management was a lot more difficult in general than I thought it was going to be. And so we actually ended up, the management company we changed from, or actually changed to, is the same management company we used in DFW. We brought them up there from DFW. It was their first deal. Of course, there were challenges of it being their first deal in Oklahoma City, just like there were challenges for me as well. They just didn't have all the connections and resources that you would typically have. But now, a few years later, they have, I think over 3,000 units in Oklahoma City.
Oh, wow. That's awesome. Well, Dustin, I want to thank you so much for taking your time to be with us here today and sharing with us about this particular asset. We were talking in the green room about another asset that we wanted to talk about. And so we're going to schedule a time to do that other one. So for those of you who are listening, stay tuned for the next episode, version 2 or whatever of Dustin's next property that he wants to go over. And so we will definitely have you back on to do that, Dustin, and also continue to have you back on as you close more deals, and whether you're exiting them now or getting into them right now as well. So you had a lot of good golden nuggets throughout this one. And how can the listeners reach out to you if they want to contact you, follow you a bit more, maybe jump on a phone call to discuss some possible partnership opportunities?
Yeah, sure. So my I guess website that I'm putting up is cowtowncap.com. You can also reach me at my email, Dustin@milesmultifamily.com, or join Dan's group, or find me on Facebook. I'm pretty active on Facebook.
Well, again, thank you so much, Dustin, for being here, and we're going to get you scheduled to come back for another episode. So thank you so much, and looking forward to that second episode.
Awesome. Thank you. Really appreciate it. Had a lot of fun.